Today, we're going to talk about building a portfolio, but not for 5 or 10 years. We're thinking much, much bigger. We're building for the long haul, 50 years into the future. So let's imagine it's 2025. The big question is, how do you construct a portfolio that can handle whatever the world throws at it for the next half century? You see, it's not just about growth, it's really about survival. Let's dig in. Here's our game plan. We'll start by defining what this 2070 challenge really looks like. Then, we'll introduce our 3 contenders. After that, we're going to unmask the single biggest threat to your long-term wealth, see how a legend built a company to fight it, and finally, we'll piece together the optimal portfolio. You know, when your timeline stretches out to 50 years, the rules of investing totally change. The goal is no longer about getting the biggest possible gain in any one year. It's about protecting the one number that truly dictates how your wealth compounds over decades. This is so important. There's a huge difference between the arithmetic average and the geometric mean. The arithmetic average can fool you. Say you gain 50% one year and lose 50% the next. The average is 0, right? But you're not even. You're actually down 25%. The geometric mean, however, tells you the real story of your portfolio's actual growth. And over 50 years, that is the only number that truly counts. To build our 2070 portfolio, we're going to look at 3 very different assets. First up is QQQ, the NASDAQ 100 ETF, which is just packed with the biggest names in tech. Then we've got Berkshire Hathaway, Warren Buffett's legendary company. And finally, SPY, the S&P 500 ETF, which gives us a broad slice of the entire US market. And wow, this table really captures their personalities perfectly. Look at 2023, a huge year for tech. QQQ just soared, up over 54%. But then look at the very next row, 2022. It got hammered, down almost a third. And Berkshire Hathaway? It actually managed to eke out a small gain. This isn't just data. It's a story about risk and resilience. So this is the key takeaway here. QQQ is your growth engine. It's a concentrated bet on innovation, which is exciting, but that concentration means extreme volatility. Berkshire Hathaway, though, is built completely differently. Its entire DNA is about stability, about surviving those nasty downturns, and about protecting capital above all else. But simple volatility isn't the real villain in our 50-year story. The true enemy, the thing that can wipe out decades of your hard-earned gains, is something called maximum drawdown. To put it simply, this is the most painful drop you would have ever had to live through while holding an asset. It's the fall from its absolute highest peak to its next lowest point. Think of it as the ultimate stress test for an investment. Just let that number sink in. That's what happened to the index that QQQ tracks when the dot-com bubble burst. If you had $100,000 invested, it would have shrunk to just $17,000. That's not just a loss of money, it's a catastrophic loss of time. And here's the brutal math that makes these drawdowns so dangerous. Losing is not the symmetrical opposite of winning. If you lose 83%, you don't need an 83% gain to get back to even. You need a nearly 500% gain. A comeback like that can take more than a decade, completely destroying that beautiful, smooth curve of long-term compounding. You know, this famous quote isn't really about avoiding any loss at all. It's about avoiding these kinds of catastrophic losses. And it's the very philosophy that led Warren Buffett to build a company designed specifically to do just that. So let's take a look under the hood of Berkshire. It's not just a big pile of stocks, it's a financial machine that is engineered for resilience against the very shocks that can cripple other investments. This right here is Berkshire's secret weapon. At its heart, it's a massive insurance business. So they collect premiums from customers today for claims they might not have to pay for years. That giant pool of money, the float, isn't technically theirs, but they get to invest it for their own profit. It's a permanent, interest-free source of capital that funds like SPY and QQQ just don't have access to. And Berkshire's other superpower? A mountain of cash. Unlike index funds, which pretty much have to stay fully invested, Berkshire can hold back. And this cash isn't just sitting idle, it's a weapon. It allows Buffett to go on a shopping spree when everyone else is selling in a panic, turning market crashes into huge opportunities. So when you put it all together, the insurance float, that strategic cash pile, a portfolio of rock-solid businesses, and a clear plan for the future, you get a company that's built to be a defensive powerhouse. It's designed to be the shock absorber for your long-term portfolio. Okay, so how do we combine all of this?
For a 50-year journey, the answer isn't to bet on a single horse. It's to build a team where each asset has a very specific job to do.
Now, you might be tempted to just split your money equally, a third in each, but that would be a big mistake. Why? Because it treats their risks as if they're the same, and they're not. QQQ's massive volatility would completely hijack the portfolio's performance, canceling out the very stability you added Berkshire and SPY for in the first place. A much smarter approach is to assign roles. Think of SPY, which represents the broad U.S. economy, as your core foundation. Berkshire Hathaway is your risk mitigator, your shock absorber, and QQQ, that's your growth catalyst. It's a controlled dose of innovation that you add carefully to boost your long-term returns. And this brings us to what an optimal allocation could look like. We put the biggest piece, 40 to 50%, in SPY as our stable foundation. Another 30 to 40% goes into Berkshire Hathaway for defense. And then a smaller 10 to 20% slice is for QQQ to give us that shot of growth. This structure is all about capturing the upside while protecting our capital from those killer drawdowns so our wealth can just keep on compounding for the next 50 years.
So let's end on a final thought experiment. If you were forced to put all of your money into just one of these for the next half century, which one gives you the highest probability of not just growing, but truly surviving? Well, while Berkshire is a fortress and QQQ is a rocket ship, the most robust choice for a single 50-year bet is SPY. It gives you the ultimate diversification. You're not just betting on tech, and you're not betting on a single company, no matter how great it is. You are betting on the entire American economy. It's the path of maximum survival. In over 50 years, survival really is the foundation of success.